All right, yeah, you guys will notice my Twitter handle is US GAAP Guy. I currently have 3 followers. 2 of them are my children, so feel free. The best thing you'll see on there is I did a presentation in Tulsa last year. And I came, it was like right before lunch, and everybody was like, dude, just do your hour and get out of the way. As I'm walking up there, for some reason, I just thought in my mind, I remembered, you guys remember when Ellen DeGeneres shut down Twitter? When she took a selfie at the Oscars? Yeah. For real. So I get up there, and I can tell they're all, like, not like you guys. You guys are all really engaged. And I'm really pumped. And they're all just like, I was like, you know what we're going to do? We're going to take a picture. And I literally took a selfie. That was with me, and everybody in the background was like waving. Did not shut down Twitter. But that's probably the funnest thing you'll see on there. I put some nerdy stuff. So I've been with RGP almost 3 years, pretty much exclusively been developed, helping companies implement new RevRec standard, and now working on Lease Standard. I'm also kind of the firm's one of the handful of experts on all areas of GAAP. But I will be completely honest with you, stock comp, don't ask me questions about stock comp, because I was 9 years at USAA and we were private when that came out, and I dodged that bullet, and I haven't decided to climb that hill yet. But we have plenty of folks in our firm that are stock comp experts, but that's probably the one area that I am not going to be too involved in. All right, so we're talking about 2 areas. And I'm going to give you, we can talk about anything. On my bio, you probably didn't see this, I actually spent a year as a professional golfer between Deloitte Touche, and I didn't know what I wanted to be. So we can talk about golf. I can teach you guys how to hit a draw. You can teach how to stop hitting the draw. That would be helpful. We're going to talk about RevRec and leases. And what I thought I would do is, you guys are probably all sick and tired of hearing about RevRec, right? Some of you saw this and like, oh great, another RevRec presentation. But what I want to talk about is the stuff I've seen in the last 2 years, companies trying to implement this, areas they've run into with problems with the standard, and just kind of some other general observations, right? And then we're going to talk about leases. Now, it's really interesting to compare these two, because when we talk about RevRec, we can talk technical accounting for days, right? Super, uber technical. You need experts to interpret RevRec and implement RevRec. You get the leases, and I'm going to prove to all you guys, you already know the new lease standard. You already do. It's a 500, you can go to 8-hour CP sessions, you can do all you want to do. In 5 minutes, I can prove to you, you need all you need to know from the technical accounting side of leases. It's the other stuff that we'll talk about. All right? So, all excited? It's going to be an hour. It's going to go so fast, you're just going to die. I can't believe he's done already. He's done. Are you guys doing all right? All right, so let's talk about RevRec. I kind of forgot. Okay, I kind of forgot because I did this yesterday. I should remember what I have on here. So I'm going to walk through a couple of the technical areas, two or three of the really technical areas in the 606 standard that I've seen companies struggle with, and I've created some flow charts that I think would help you. The very first one is identifying performance obligations. Step 2. You guys struggle with that step? You know why you struggle with that step? Because no one knows what the hell distinct and distinct within a contract means. Nobody does. In English, you cannot explain what that means. So what I try to do is rather than tell my clients, because you sound like a nerd when you say distinct and distinct within context or contract, I try to create a flow chart that you guys can use and maybe help you kind of understand the concepts of whether you have multiple performance. So this is, you guys, you looked at a contract and you have all these promises, right? You read this contract and I promise to do this, and do this, and do this, and do this. Are each one of those separate? And do I have revenue attributed to each one? Or do I combine them all? Or do I just have one? Okay? This is, to me, this is probably the most difficult piece of 606 to implement. So, first question you ask yourself, are there multiple promised goods or contracts in the contract? The answer to that is no. You're done, right? And then you're done with step 4, right? Because you don't have any purchase price to allocate, because you only got one, right? We all want it, that's where we all want to get to, is one. Every contract that has one POV, we're done, all right? If not, then you ask yourself, do each of the promised goods or services meet any of the following? You notice I didn't go through the step of, is each one of these distinct? Because I found 99.9% of the stuff you guys promise in contracts is distinct, okay? It's whether these multiple things should be bundled together and treat it all together, okay? So it means any of these following, and I call them A, B, and C. In the guide, it's like, like 25, 21, and 22, something like that. But the very first one, oh, I have a client name up there. Sorry, you guys ignore that. Ignore that. All right, I created this slide for a client, so anyways. Do you provide a significant service of integrating the goods and services with other goods and services into a bundle that represents a single output? So you have to ask yourself, that's a judgmental exercise. So when I promise to do A, B, and C, am I doing them all really individually? Or do they all get combined and it's one thing that my customer accepts? Okay? That's judgmental. You're going to have to probably step outside the controller shop and talk to somebody else, legal or operations stuff, to figure that one out. Number two, this one's easier. It says one or more of the goods or services significantly modifies or customizes another good or service. Okay? And that one's more objective. So the example I was making this one is you have a piece of machinery, right? I manufacture a piece of custom machinery and I install it. Okay? When I install it, am I plumbing and piping and wiring and basically modifying that original piece of equipment to now it's a single piece of equipment because the installation modified the equipment? Say yes, then you have one view. Or C, are they highly interdependent or highly interrelated? And this one is, they have to depend on each other, not one without the other. Good example on this one, again, if you have a piece of machinery that has software in it, right? Basically, actually I have a client that builds automated forklifts, okay? So it's this forklift and it can go around the factory, it's all automated, it follows these sensors and everything. So it has significant IT, or it really has a license embedded into it, and it has the forklift. Well, does the forklift work without the software? No, you just have a plain old forklift, right? And will the software work without the forklift? No, the software has to go in someplace. So in that case, I would say they're highly interdependent. Okay? The answer is any of these is one. If you can say yes to either A, B, or C, you have multiple promises in a contract. Can you say yes to A, B, or C? And remember, A and C are judgmental. C is more objective. Okay? If you answer yes to any of those, you have one performance obligation in the contract. Even though I might have all these little things in it. And by the way, there was an update in 2016 that says not only if you meet A, B, and C, you only have one POB, you can also say, is it immaterial? Is that one POB or is that one little promise in there? And I've defined, for this client, we defined it at 5% of the contract price. So a good example on that one is you might have a contract and you might have I have to send a report to the customer at the end of every month, giving them a list of all the reports, right? Now, the customer might say, yeah, I rely upon that report, I need that report, it's really important, and it might not be A, B, or C, but you could say the cost of producing that report is clearly less than 5% of the total cost of the project, then it's immaterial, okay? The example, the one, the FASB, when they put this in, because they specifically said you can evaluate performance obligations on materiality, and the example was, I think, Coca-Cola made the example, or if you look at a bottle of water, you see an 800 number on there, on your bottle of water. When the standard first came out, it goes, oh geez, I sell water and I provide a customer service hotline, right? And everybody was like, come on, really? You really want me to defer 1% or 1/2 of 1% of the revenue over this future period for this hotline service, or can I just disregard that? And the answer is yes, you can disregard it. If the answer is those is no, oops, then you have, I don't know what the last box came up. Then you have multiple performance obligations. So hopefully this, and by the way, you guys don't have the printed slides, because I kind of just did this last night. Don't tell my boss that, who by the way is Shauna, just so no pressure. But we can get you guys these slides. I have some other stuff I can also get you. They're kind of fun. All right, so that's step 2. You guys, does that make more sense? Have you guys struggled? Probably, I'm not going to sit here and ask you questions. Some of you can say, yeah, step 2 sucks.
Yeah, it really sucks.
Good. Well, hopefully this will help you with step 2. The other place I want to help you out with is variable consideration. This is the
So
one.
it's variable consideration.
That one's that three sucks too. The variable consideration is problematic. So I created a chart on this one is, let's see if we can identify what variable consideration is. So I asked if it's fixed or variable. If it's fixed, that's set in stone, right? But what if you have other stuff like return provisions, or bonus provisions, or penalties, or acceleration clauses, or failure to meet certain SLAs, right? Penalties. All those guys are deemed to be variable. The way I think about it is, when I sign this contract and it says, I'm going to get $1 million at the end of this contract, what things can happen that will result in me not getting $1 million? And they could be good guys or they could be bad guys. Okay? They could be penalties or they could actually be accelerators. Think of all those things that in this contract could say, day one, I'm going to get $1 million, locked in, solid, except for if we screw up on some SLA or some performance obligation or we have a defective product, right? That amount is going to be less than $1 million. If it's less than that, you have to identify all the forms. For each form of variable, you have to estimate, right? This is the big change in 606, where sometimes we could just wait until the event occurred, wait until it happened down the road, and then I recognize it as a detriment or a benefit to my revenue. Now, under 606, we have to estimate all forms of variable consideration on day one. Okay? Day one. And how you estimate it, it's either using the most likely amount or the expected value amount. Right? You guys know the difference between those two? Yes, you do. You want to tell me what the difference is between those two? What's the expected amount to?
Expected value.
Expected value.
That's the weighted.
Nope. There's two scenarios. Which one did I say? I'm sorry. I said the most likely amount. You're right. I'm sorry. I was saying it the opposite way. That's the probability within this, right? If you only have two outcomes, so like if you have a delivery penalty, I'm either going to deliver this by a certain date or I'm not going to deliver it. That is a expected value amount, and that's basically a pro or con analysis. Okay? Then the little kicker, right? Because everybody said, well, remember when we went to school and we learned about this thing called loss contingencies, right? When you guys recognize loss contingencies? That's 5. I normally do. When you recognize a loss contingency? When it's probable and reasonably estimated, right? When do we recognize gain contingencies?
When received.
When received. At the very, very end, right? So under the standard where it says I have to estimate variable consideration, I can have good guys. I can have, let's say I'm building a bridge in the city of San Antonio, where I'm from, over our little river walk, and the contract says if I get that bridge done by June 1st, I get a 5% bonus. Okay? Under old GAAP, when would I recognize that bonus? On June 1st, right? When it actually happened, or maybe the day I did it the day before and I got it, right? When do I recognize it under 606? When it's probable. Okay? So like in the way I like to explain it, in this expected value method, we have two scenarios. Either I'm going to meet the delivery date or I'm not going to. If it's a penalty, I book it if it's 51% likely, right? Because that's a bad guy. That's a loss contingency, right? That's a downturn in my revenue. I don't wait for those guys. I book them. As soon as it's 51% likely, right, I would book that as a loss. But if it's a gain, when do I book it? However you define probable, okay? I've defined, for most of my clients, to define probable as 75%. So once you get to a point where you're 75% likely, you've met that threshold to book a gain contingency, which is the one thing that freaks everybody out. What are you guys going to do, really? You have this big bonus coming down. You're still going to go, I don't know, it's like 60% probable until the day it happens. And you're like, hey, look, what happened? Look at that, right? So that's the last thing we want to get is the SEC comment letter on acceleration of revenue. You recognize revenue before it actually happens. But that's the 606 guideline, that's the requirement. That's the other piece I've seen a lot of people struggle with. The other people said, I have to make an estimate, right? I've never done this before. I have no experience whatsoever in this form of variable consideration. How do I estimate it? So I tell them, how did we value financial instruments in 2009? Right, when we said there was no market for this stock or this bond. We figured out a way to do it, right? At the end of the day, I have to make an estimate. You cannot say, I don't have any evidence, I don't have any experience. You're going to have to come up with an estimate, okay? Are there auditors in the room? Do you have any auditors? Okay, one. I won't make that mean too much. They will beat the crap out of you in variable consideration. And they should beat the crap out of you one way, whether it's a good guy or a bad guy, right? You should give them just enough hard time if they're sandbagging, basically preventing the gains up there until the very end, as if they're keeping losses off until later time. It should be equal representation. All right, so step 3. The last step, oh, and by the way, a little star came up. Not only do you do this at the inception of the contract, you do it every quarter, you have to update it. Some of you with very long life contracts, multiple year contracts, you get to do this exercise every quarter. All right, and the last step, the two pieces that I found that people got caught off guard is this third piece, okay? The standard says if I meet one of the 3 overtime criteria, I must recognize it over time. If I don't, then I go to point in time, okay? And so people read the standard, and actually the standard when it was first exposed, this was not on here. It was just those 2. What's that, you guys? That's service contracts. The example is cleaning service, right? You sign up, the folks come and clean out your office every night. So whether I bill on a monthly basis or a bill on a quarterly basis, they're performing that service every single night, so they should recognize the revenue right when they do it. The second one is enhances or creates an asset that the customer controls. That makes sense, right? Because the customer already controls the asset. This is a control standard. I recognize revenue, my customer takes control. If they already control the asset, then that makes sense you go over time, right? The great example I've seen on that one is, it's from a home builder's perspective. I have some buddies in San Antonio, they're construction guys, and they're like, well, we're not crazy about this because they use percentage of completion all the time. When you go into it, you guys probably didn't know this, when you drive into a neighborhood and you can buy the lot and then hire a builder, you own that land, right? And now when they put that house on it, what are you doing? You're enhancing the value of the land by putting a building on it. So that builder would recognize the manufacturer of that home over time. What if you go into a developed neighborhood, developed subdivision, and you buy the land and the house? How would your builder recognize the revenue on that house build? Point in time, because you don't own anything until they're done. Okay? But the one that's gotten a lot of people, I have multiple clients, almost every single client, they're like, dude, I ship and bill. They order from me, and I ship it when they order from me. I'm done. But we looked at that third criteria, and that third criteria was basically added very late in the process. That's the percentage of completion model the construction companies use. And the way they got comfortable with this, if you're you have to have both things. If you create an asset with no alternative use and you have an enforceable right to payment, right, at all times during the construction of that asset, you meet over time. So think about that. Think about the folks that do that. They're building custom equipment. They're building power plants. My dad was a civil engineer, and he built power plants for a living. And they use percentage of completion revenue. And so now they continue to use percentage of completion because now they're following under this one. Has anybody evaluated their products or what they do for a living and thought they were a ship and bill or a point in time, and then ran into this one and went, uh-oh, what does that mean? What do you guys produce, can I ask?
Food packaging, so normally like a water bottle,
Uh-huh.
except when you stamp on the Starbucks.
Yes, on the
label,
side of it,
custom
now it's
specific.
no alternative use. I have a client that manufactures boxes, right? And they print Heinz ketchup, or Heinz ketchup on the side of it. It just went from a standard box to a no alternative use box, okay? So you might say, well, what's the big deal for like my client that's a box manufacturer? Well, how long does it take to make a box? 2.3 seconds, right? Problem is, this client makes the boxes, they put them in their warehouse, and they ship them when the customer wants them. Under the old method, they didn't recognize revenue until it shipped, right? They made the box and sat in the warehouse and shipped. When do they recognize it now? If they're over time, most likely they're using a cost-to-cost model, they recognize everything up front. So 99% of the revenue gets recognized when they build the box, and 1% while it's sitting in the warehouse for 3 months. Have you guys run into something like that? Or just you found your products were more unique than they were under the old standard? Okay. So I don't think a lot of people struggle with this, creates an asset with no alternative use. That one's kind of easy. It's the second one, enforceable right to payment. So again, I have clients, and this one's interesting, and I'll pick on the auditors in a minute. The auditors have not given us clear guidance on how to interpret that enforceable right to payment. So what basically is your contract has to have a cancellation clause in it that says if they cancel without cause, they have to pay you for all the work that you've done up to that point, plus profit. Okay? And so folks that have these provisions in their contract, and actually in the United States, it's almost like a standard feature, the cancellation clause. But in some cases, it's silent. And in a lot of foreign countries, it's silent. So what do I do when it's silent? You get to walk down the hall and talk to your legal department. And that's what the firms have been telling us. It's based upon, and I can tell you in the United States, because we have the Universal Commercial Code, right? Uniform Commercial Code, the UCC, there is case law where people have pursued action and won verdicts on cost plus margin, right? So you can say we operate in a jurisdiction where that's a possibility, but your legal department has to say, what's our position? Would we take a client to court? I have clients that do with the silence thing, they're working in the exact same environments. Some have said we have it, some have said we don't. Meaning, we don't think it's reasonable that we could go to court.
So if you don't go to court, then you would say it comes a point in time.
Yeah, because you don't meet because it's and.
Right, so you
Right?
can stamp the box with whatever, but if you're not going to enforce the payment against your client because you sell millions of dollars of other stuff to them.
Exactly.
Okay.
So you know what my client did? Because their legal department said, yes, there is UCC case law, it's silent. We have the not whether we do it or not, that's not the point. The point is it enforceable? Do I have an enforceable right? And the answer was yes. You know what they did? They sent a letter to their customers that said, if you cancel, we will not sue you. But guess what? Their top 25 customers are the Walmarts and Amazons of the world, where they would never sue them anyways. So they basically put in writing what they would eat it. And, you know, right, if your customer, something bad happens, you need it because, you know, there's goodwill and you want to. So their business decision is in line with that decision. So, but this is one where I've seen, and there's a, you guys know what the TRG is, Transition Resource Group? There's a TRG paper, it's number 43, that gives you just more color on how you should evaluate. I've actually had another client that does business worldwide. They engaged an outside firm, and that outside firm I think they're up to like 30 jurisdictions, went and look, and they've taken the position, yes, in the US, we have an enforceable right. In the UK, we have an enforceable right. In London, in Sweden, we have one. In Brazil, and they actually went through all the countries that they did business in and made this evaluation. So that's one I've seen people struggle with, right? So if you're a point in time, you're like, what's the big deal, right? Well, guess what? The standard has 5 points of time. And the standard says you recognize revenue at the earliest of one of these 5 things happening. Okay? So if you have a present rate for payment, that's almost like the cancellation clause. You recognize it right up front. Or when title transfers, or when physical possession transfers, or when risk and rewards transfers, or when the customer is accepting the asset. It's the earliest point of any of those things happening. Except for technically the last one could be at the end. But you guys know what we use today? Which box do you guys use today? You know? I can guess which most of you use. You use that one. Because you know what this one is? That's shipping terms. Eco terms align with rewards and ownership. It doesn't dictate title transfer. It says rewards and ownership. Okay? So most of my clients, what they've done, they go, okay, this is one of those, all right, I have these 5 options under 606. 99% of the time, transfer occurs when I ship it. It'll be shipping point or destination, whatever it is. There could be some outliers. I'll do a little work to find out what those outliers are and if there's a significant time difference. And they said, you know, guess what? We're just going to stick with shipping terms. That's what most, at the end of the day, most of them come down for. All right? All right, there's one more. Oh, costs. What do you guys dealt with costs? This is kind of funny because
Can we go back to number 2?
Step 2 or this one?
Step 2, distinct in the context of a contract.
Yeah.
What does that really mean?
That's why I try not to explain it distinctly in the context of contract. It's not distinct if it meets one of these 3 provisions. So you want to get to it's not distinct. So it's one performance obligation. So if it's one A, B, or C, sorry the sun's shining on there. That's how I've explained it. How most people, the best way to illustrate it. All right, you can go to the next one. The last one. I got to ask before I do this. Is anybody from Ford Motor Company here? Any of your friends or family work at Ford Motor Company? Yeah? Okay, you're not going to like this. Okay. Next one. Oh, let's do costs real quick. Sorry. Costs. Now, regular costs, I think we're all familiar with. It's this notion of acquisition costs. Have you guys found that you actually pay acquisition costs and you really, in the old model, you just expense it, right? Or in the new standard, if the amortization period would be longer than a year, so that basically if your revenue cycle would be more than a year, you have to capitalize and then amortize it over that long period. How many of you struggle with what an acquisition cost is? Yeah? It's incremental and only result of a successful sale. So the one thing, it's very hard to come up with examples other than commissions, right? You pay a sales commission to either inside or outside party when you make a successful sale. That payment doesn't occur unless the successful sale occurs. Okay? To acquire that business, you sell a commission. There's some other stuff. Sometimes there's some taxes, some like premium tax or sales tax or something they could involve. But the vast majority of the things that are in scope of this piece is right here, these acquisition costs. So that's what this means. Costs incurred would be regarded, or would be incurred regardless of sale and expected to be recovered. Those are acquisition costs. Now they gave us the big out on the less than 1 year deal, but I have multiple clients where their contracts go 2-3 years. Now they have to set up this whole capitalization and amortization thing they never had to do before. Right? I actually grew up, you guys look at my bio, I actually grew up in insurance. And deferred acquisition cost is like the number one thing you learn when you get in insurance, especially life insurance. So I got to this and I was like, yeah, I know what an acquisition cost is. So easy, everybody knows what that is. But if you're not grew up in that industry, you're not familiar with acquisition costs. All right, last example, I want to go through disclosures. And so hopefully you guys have already dealt with all these issues I've dealt with. And so maybe I just reaffirm, yeah, step 2 sucked, right? Step 2 was really hard to get through and I really struggled with that. And I wish you were here a year ago to show me that chart, but thanks nevertheless. Where most of you should be, if you're a public company, which calendar year ends, you're adopting in 3 months, right? Some of you just went, oh man, 3 months? Actually, less than 3 months, right? Kind of like when my first wife got pregnant and she was like 6 months due, and I went, oh crap, it's only 3 months away. A kid's coming. Like right early on, you're like, yeah, we're pregnant. Woo! It's all right. And then you're like, oh no, right? That's how I kind of feel right now. I'm like, oh no, the baby's coming in less than 3 months. So it's disclosures. Hopefully, most of you are in the disclosure phase. You're looking at performance or preparing performance. You've actually looked at some of the early adopters. You guys know there's been like 6 or 7 early adopters, pretty big companies. Kind of looked at their footnotes, looked at what they disclosed, kind of give you a sense. And I want to remind you, because I did a presentation a couple weeks ago on SEC comment letters, and I created this chart. This is under today's accounting standard. In 2016, the 6th most comment that people got in their SEC comment letters was attributable to Rev Rec. Okay? In 2015, it was number 4. So actually it went from 4 to 6. It went down. So I just want you to keep that in the back of your mind when you think about the new Rev Rec disclosure. If you think the SEC was making comments on Rev Rec, the old Rev Rec, it's been around forever, right? Now, what's going to happen when they see the new Rev Rec disclosures? I'm nervous, okay? And what the piece that I'm most nervous about is disaggregation. As you guys know, there's a requirement in 606 that requires you to disaggregate your revenue at a level below your reportable segments, okay? So think about your current reportable segments, 2, 3, 4. Actually, I know some of you probably have 1. Still don't know how you only have 1, but you have 1. But you have to go a level below that. And they said you might want to look at customers or products or geographic areas or types of contracts or point in time over time, right? They have all these examples, things for us to think about. And they said think about what you present to external investors in presentations and evaluations and press releases. Think about how you do. Now this isn't segment, it's not a full-blown income statement, it's just the revenue piece of this, right? You're supposed to think about this. So I went to the early adopters, and 2 of them, one of them was Ford, okay? I was like, gosh, that should be really interesting. I want to see Ford's disaggregation of revenue footnote. That's it, right? They had 2 segments, automotive and finance. This is where you can tell your friends or family members, I tease them. They have 2 segments, right? And below the segments, they said, okay, let's give you guys some more information, and let's break it out a little bit further. Really? Vehicles, parts, and accessories. Their total revenues at the end of March 2017 was $36 billion. 34.9 billion is in one line vehicle. So guess what I did, right? Because I actually had a client, the box company that I told you about, their CFO said, I'm not doing this. We already tell them way too much. I'm not doing this disaggregation footnote. I'm like, you're a public company. You don't have a choice. Be a non-public company because they have an option not to do it. You're a public company. You have to comply. So I looked at Ford's. I'm going to show you guys something. So that says vehicles, parts, and accessories, 34 billion, right? So I went, which is probably what the SEC staff was going to do, and where did I go? What's the easiest thing to find additional information? I went to Ford.com, went to Investor Relations, and found their first quarter. I'd say this was July. July earnings release. What does the top line say? You guys read that? I can make it bigger. I think I can make it bigger. Yeah, I can make it bigger. What's it say right there on top? Now this is vehicles, okay? But the sales of vehicles. They said 200,000 vehicles in the month of July, 159 days on count through retail, 40,000 fleet. They sold 8,000 trucks, 71,000 SUVs, and 48,000 cars. Did you just get more information from that top line of that press release than you did their footnote? I'm not saying. It's been, PwC is our auditor, it's been signed off on, but I saw that and I said, that's interesting. And then I went further. If you go down, let me go down a little. So in their press release, they even disclose sales by brand and by type. So for Ford, you can see how many Fiestas, Focuses, C-Max Fusions. Look how many police interceptor sedans they sold. 604. I didn't even know they made those anymore. But they sold 643 of them in the month. So what I'm telling you guys, if you do what Ford did, it didn't take a rocket science. Believe me, I'm no rocket scientist. I just went to their website and looked at it because I said, really, that's all? They never really give any detailed information about trucks or cars? It's right there. So that's exactly what the SEC is going to do. And I looked, they had not gotten a comment letter, but it won't be public. Comment letters aren't public until like 90 days after you guys respond, so it probably won't be there for a while. Okay. So I'm not your auditor, but I'm just giving you an example of something that it raises questions. I'm not going to say it's wrong. I'm just saying it raises questions because I found additional detail about what they sell. Example that I'd like to show you also is Raytheon. It's an early adopter. I want to show you this one because the head of accounting policy at Raytheon was on staff at FASB when they wrote 606. So if you want to know, in my mind, if you want to know what the FASB was thinking when they wrote the disclosure requirements, look at Raytheon's financials. They've got pages and pages and pages. And this is an example of what they did with disaggregation. They broke it out by, on top, geographic. So here's their segments for us here, right? They have 5 segments. They had $6 billion total. And then they broke it down by geographic. You notice that total $6 billion. This is by major customer. And then they did it by type of contract. So I just showed you 2 extremes, okay? And in disclosures, it's always an argument about materiality and relevance. There's always discussion with auditors. So you can see of just the 8 companies that really adopted, the public companies, you saw 2 very dramatically different presentations on the disaggregation. But that's been the biggest struggle I've seen. Okay?
What transition method to these companies?
Ford was modified. Raytheon was full. And it was about, and really it was funny, I think of the 8, I think I've seen 8 earlies, and 5 of the 8 were full, and 3 were modified. It makes sense for some of like I'm kind of surprised Sprint didn't do early and do full, because my buddies, the head of accounting policy, they started implementing 606 in like 2015 or something, 2016. So I think these companies they knew it was going to be a big impact, they were on it early, so they did full. Okay? All right, that was Reverend. Hopefully I didn't scare you guys too much. I should ask, how many of you, say this, are not adopting on 1118? You're not adopting, good. Good, all right. The rest of you, give you something to think about. Give me a holler. All right. Oops. So now let's talk about leases. I want to show you, I'll go through some of the technical stuff, but I want to show you, and I don't know how many webcasts you guys got into. You've seen all the firms that put out all these RevRec guides. And in fact, I had a client that just went to a 2-day leases training session. I was like, what the heck did they talk about for 2 days? Because I can tell you everything on the technical accounting side with you about leases in about 30 minutes. So I want to go through a couple of the areas where, one area I think most of the one, okay, there's two challenging areas in the new lease standard. One is embedded leases, and I'm going to talk about that in a minute. And the other one is, now I know I need to put all this stuff on my balance sheet, what's my discount rate? Okay? So the standard will ask me, the discount rate that I use, it asks me, is the rate implicit in the lease readily determinable? If it is, I use the implicit interest rate. If it's not, and I'm a public entity, I use my incremental borrowing rate. And if I'm non-public, I use a risk-free rate. Okay? So I look at that and I go, I kind of get that. Incremental borrowing rate, that basically is the rate I'd have to pay if I bought it rather than I leased it. That makes complete sense to me, right? But I'm not sure if I know, well, when the standard came out, I know now because I looked it up. But when you read it and you're like, what the heck what does an implicit interest rate mean? Okay? It wasn't completely clear to me when I read the standard for the 10th time what that meant. So what do we do when we need to figure something out? We Google it, right? We Googled. So I Googled implicit interest rate. And the answer I got, I think it was from like Investopedia or something, you know, that Wikipedia, but it's like for invest, you know, like, right? So it told me my implicit interest rate is the rate that causes the sum of the two following items. The present value of my lease payments plus the present value of my basically residual equals the fair value of the asset plus my initial direct costs. If anybody can tell me what that means, I'll give you like an extra hour CPE. But so I read that and I go, I still don't think I understand what implicit interest rate means. So I Googled it again. But this time I said implicit interest rate example rather than definition. And I got this, right? I kind of created this example from that. So I think you're going to get this in a second. So I acquired a new car in the lease. The selling price of the car is 10 grand. I'm going to put 1,000 down, and I'm going to pay $3,500 at the end of each 3 years. What's the implicit interest rate in this lease? Okay? So you create a little spreadsheet right here. So the receipt is the inflow, right? Inflow of the car. And I paid that 1,000 at the beginning and these 3,500 at the end of each of these 3 periods, so that I have my net cash flows over on the right-hand side, right? And so when I looked at this example, it said there's a formula in Excel called the IRR. And so if I IRR that 9,000, that 3,500, and those 3,500s over that 3 periods, I get 8.12%. I was like, oh, IRR. I always refer to IRR as internal rate of return, not implicit rate of return. Implicit interest rate. Okay? So, but I want to explain to you guys, this is all key on knowing what number. That.
Well, didn't that say something about the cost, though? You had, instead of the receipts that you...
Well, that was in that crazy formula. This equals the same. It's the same rate in this example. I didn't give you all that piece, but it would. Right? But the key of this one is, in order to use an incremental borrowing rate, you have to know that number. Right? So when you guys go lease 10,000 copiers, do you know the fair value? Or when you lease the floor of this building, do you know the fair value as the lessee? Probably not, right? Does your lessor know it? Not only yes, but heck yes, because that's how they priced it. That's how they came up with, that's the return I need on this asset. Okay? So that's, from a technical standpoint, that's kind of the thing. Next thing I want to do is lease classification. So you probably heard we now have operating leases and financing leases. And this is where I want to prove to you that this is not much different than you know today. Okay? Does anybody know the difference between, there's 4 criteria in current GAAP. Now, does anybody take the CPA exam within the last 3 years? They should know this right away. But there's 4 criteria that determine whether you have a capital lease. anybody remember?
90% fair value,
90%?
75% economic life, transfers ownership or bargain purchase.
Very good. You guys hear all that?
He's old.
Yeah.
I know, he knows that. That's impressive. I'm impressed. All right, you guys want to see what the new classifications are? So those were the old, and those had bright lines in them, right? 90% of the fair value, 75% of the useful life. And the FASB says we're not writing rules anymore, we're writing principles, right? You want to see what they came up with? Now there's 5 criteria, all right? The new criteria are, does the ownership of the lease transfer at the end? That's the old rule, right? You got a financing lease. They don't call it a capital lease anymore, they call it a financing lease, right? Is it reasonably certain to exercise an option to purchase the asset at the end? It's a bargain purchase option, right? But now this new word, reasonably certain. What does that mean? Reasonably certain. I know what probable means, I think. I know what remote means. I know what reasonably possible. I know what more likely than not is, but what is reasonably certain? Okay, how about if I ask it like this? Is it reasonably certain the Cubs will win tonight?
No.
Is it likely?
No.
No. Well, you're down on them because they're down 3. Are they down 3-1? Is that what it is? They're down 3-1?
Because Kershaw's pitching.
Oh, because Kershaw. So now it's down to remote. Now we're down to remote. So when I say remote and I say reasonably certain seems higher standard, right? I've seen most of the clients interpret that as 60%. I'm sorry, reasonably certain is higher than probable. It's more like 80 to 90%. Right? So when I say it's probable the Cubs will win, or it's reasonably certain the Cubs will win. Reasonably certain sounds like a higher threshold, right? All right, the next one is the lease term for a major part of the remaining economic life? Major part. That used to be 75%. Now it's not. It's major part. Okay? The fourth one is the present value of lease payments equal to substantially all? That's the new term, right? You guys see? And then the last one is it's operating lease unless it has no alternative use. That's the fifth criteria. And no alternative use is just how we define it in the Rev Rec. Okay? So I kind of chuckle at this one when FASB says they made a principle-based standard. Does anybody play DraftKings or FanDuel? You guys are lying to me because they didn't make $90 billion last year and nobody in this room. So and you guys remember that scandal a couple years ago when like some guy knew what they were all doing and they said, wait, how is this legal? Fantasy football, online fantasy football is gambling. And they said, no, it's not. It's a game of skill. Which is why I lose every week, right? So I chuckle because I'm like, DraftKings said gambling basically is skill, just like the FASB said, this is a principle-based standard. And by the way, you guys, do you know in the basis of conclusions, the very first question was asked in there, can we still use 75 and 90? You know what the answer was? Yes. So I don't know. The point of this slide right here, you guys, everything that the new lease standard is written on is based on current framework. You already know it. Okay? The only thing that's changing is balance sheet presentation of operating leases. And I have, here I'll show you guys real quick. I'm not going to show you this, but I have a really cool Excel spreadsheet. And it actually illustrates financing and an operating lease. Oh, and then you do journal entries. And then you have operating lease, there's all the facts, and then you do the example. Okay? You guys want this Excel spreadsheet? It's fun to play with. And I kind of suck at Excel, but I actually created this one. So, what I want to show you though is the result of those two examples. Okay, and in both of those examples, on day one, I created a $48,000 asset and liability. Because on day one, financing and operating leases, you're putting the present value of future lease payments on your balance sheet. So it doesn't matter if it's a financing lease or an operating lease. Day one is exactly the same. Day two, and the example is year 1 through 3, here's the result of a financing lease, and here's the result of an operating lease. What I want to point you to is the expense. Okay? The FASB made a considerable effort to make sure that the new standard for operating leases on the income statement is exactly like the old statement, right? Under the new standard, you would actually recognize, in my example when you see it, straight line expense, straight line rent expense for all 3 years, and $52,000, which is exactly the same up here. The only difference is assets and liabilities are now on our books, okay? So when you see the example and then you kind of look at this chart, you go, okay, yeah. The only thing that's different, like yesterday, so the income statement is exactly the same. The only thing that's new are these assets and liabilities that appear on your balance sheet. Okay? So from a technical accounting standpoint, and my RGP consultant, my colleagues, and my boss hate to hear me say this is not. RevRec was a highly technical accounting exercise. Leases is not. Okay? Because you know 95% of it right now. You know 95% of the standard. You might have to do some homework to figure out how the asset and liability comes off your books, right? But my expense is not going to change. Okay? So why is leases?
For an operating lease, do you actually show it a gross asset and accumulated amortization?
No.
No. they're
Not for an operating lease.
Just, they're not.
No, your asset and your liability, you put up the present value on day one. At the end of, let's say it's 3 years, my example, all you do is recalculate what the present value is after the end of the first year, and you relieve the asset and liability by the exact same amount. So on operating leases, you'll see your assets and liabilities drop. It'll come off the balance sheet because they offset each other.
But you don't use an accumulated amortization?
Nope. But for financing, you do. That's the old capital model, right? So-
I thought, maybe I haven't looked at this long enough, but I thought the whole purpose of the lease, an operating lease, was not to have it on the balance sheet
No.
to begin with.
All leases are on balance sheet.
That's the big difference.
Greater than 1 year, they made an exception. If you have less than 12 months, all leases are on the balance sheet. And by the way, you guys, international version of this, it's all financing lease. They didn't do operating leases. So amortization does show up on your balance sheet under the international models. So really just learn the GAAP one and then throw out everything you learned about operating. You know the international one, right? So to implement, so RevRec was an exercise. You had to get a bunch of accountants in there. You had to analyze contracts. You had to interpret 606, right? And understood how your business would operate under 606. Leases, the calculation, right? It's going to take some work. You have to figure out what the discount rate is and what the turn is and all that. But the number that goes on your balance sheet, pretty straightforward, right? But what don't you have today? So the number one already in all the lease engagements that we've already started companies with, it hasn't been technical accounting. It's been right there, that second bullet.
Find them.
Identify all leases and identify missing information. Because the problem is, if you guys have lease expense in your income statement or in your general ledger, and you might have supplies, or you might have all these other classifications where expense would go through, and under old standard, you didn't care, right? Because it might have all gotten lumped together in G&A, and you didn't care because the accounting for a service contract or for an operating lease was exactly the same. You straight lined expensed it, right? So you didn't really care where it showed up. So now if you say, like I think when the FASB issued the standard, you know they did not establish a transition resource group, right? So we had, for revenue, they established a transition resource group. Those guys issued 131 memos, right? For financial instrument credit impairment, they set up the transition resource group before they issued it, right? For leases, they did not. Now, they have issued a couple things. Some oil and gas guys are freaking out about some stuff. I'm from Texas, I know about that stuff. So they made some clarifications. But largely, they said, you guys already know all your leases because you have a footnote. Don't you already have a footnote? For all of your, now, might be, it's non-cancelables ones, right? It's your minimum lease commitment. You already have a footnote. You already disclosed it. So in the accounting standards mind, you already knew where all your leases were. But I say that to all you guys in this room right now, and I see you already know where it is because you have a footnote, and y'all went, ha! Sure we do. Yep, we know exactly where all of our leases are, right? So, data. Okay, I'm going to show you one more slide. You guys are going to have to talk to IT. It's the last thing we want to do. It was bad enough in RevRec when we had to go talk to lawyers, right? And we did. We talked to operations, we talked to HR, we talked to lawyers. When you do leases, inventory is going to require data exploration, and I will be very hard pressed for any of you to account for leases under the new standard on a spreadsheet. We most likely will need a system. So leases is data and systems. You guys need to lead it, right? It's on the financials, you generally manage the leases, et cetera. You need to own it, but unfortunately you're gonna have to go talk to those knuckleheads, right? The same guys who tell you every time your computer doesn't work, reboot, right? Thanks, that's helpful. Can you help me find all my leases, right? So you're gonna have to do some data exploration. And we have, not to pitch our services, but we have folks, that's all they do is they go through GLs and they do queries and they pull data. Anything that could resemble a lease, because the new standard, remember it's a lease, if you pay for it and you have an identified asset and you can use it. So, and that's my last kind of mantra. And by the way, there are lots of, unlike RevRec, because RevRec took forever to develop and everything, all the software providers were kind of behind. The thing got issued and the solutions weren't even there yet. Like SAP and, SAP came out really late. Oracle came out, I think in like 2016 or something. You'll be happy to know that they're all up to date. And there's lots of third-party providers that have system solutions, both for lessees and lessors. But this is really a lessee accounting standard.
Challenging area number one, embedded leases.
Embedded leases, yes. No problem. Just take the practical expedient. There's a practical expedient that says, now, if you don't care about how many leases end up on your balance sheet, say, I don't care, I'm just going to combine them. You can combine, if you have lease and non-lease components, you can take an accounting policy election just to combine them and call that whole thing a lease, and not separate. If you don't care about what ends up on your balance sheet, right? It's the folks that are more sensitive, no, I want less leases on my balance sheet, so I'm going to separate those two and treat the service component different from the lease component. So only the lease component goes on the balance sheet. Technically, the service component falls under 606. Okay. Right? That is, other than, I said I was going to mention embedded leases. That's what I meant in the data exercise, is there are certain things today that have embedded leases in it, or you don't consider them to be leases. But if there are assets attached to those service arrangements, then they are. Boom, man, right on the button. I mean, you guys can answer the question. No, seriously. I might contact you guys, send me an email, or unless these guys, they send me, I can send you all these little Excel spreadsheets, it's all kind of, Excel is kind of fun to play with because you can kind of see mechanically how it works.
What's your ready?
Here, let me put it back up here. I can leave this. Are you guys going to stay? Are you guys going to eat in here?
No, we're going to
Oh.
cocktail hour.
There it is
Might
right
get
there.
run over.
Oh, cocktail hour. Is the cocktail hour in there?
Yeah.
So I can leave that up there for a
Yeah.
second.
Absolutely.
Write
Thank
that
you.
down.
A little applause.